This is Financially Fit Radio with Cory Sickles from Safe Harbor Wealth Advisors. Retirement isn't just about saving, it's about having a strategy that helps you navigate market ups and downs, combat inflation, and secure the future you deserve. That's why Financially Fit Radio is here to tackle your biggest financial concerns, share actionable strategies, and help you move toward your retirement goals with confidence. And now, here's Financially Fit Radio with Cory Sickles.
Welcome back to another episode of Financially Fit Radio. I'm Cory Sickles with Safe Harbor Wealth Advisors. If you'd like any information about anything that we discuss on the show today, feel free to give us a call at 614-760-0670, or you can always visit us online at safeharboroh.com. And while you're on our website, feel free to check out our radio page. You can listen to today's show, previous shows, and you can also subscribe to our podcast, which is on Apple Podcasts, Amazon Music, or Spotify. Also, feel free to watch today's show on our YouTube channel. Just type in Safe Harbor Wealth Advisors. You can go to the Financially Fit Radio playlist, and you can also subscribe to our YouTube channel and be kept up to date when we put other videos out. We do video shorts, 4 or 5 of those a week on different types of financial topics, just in order to try to educate you on different types of financial situations. Today, we're going to talk about something that's really important, and that's his required minimum distributions. We're going to talk a little bit about the rules. We're going to talk about some ways to avoid mistakes. We're also going to talk about some ways to possibly maximize those benefits as well. But before we dive into that topic, let me introduce you to my co-host this week and every week, and that's Tony Shore. Tony, how are you today?
Oh, Cory, I am doing well. I have had a fantastic week. And I'm excited because it's my favorite time of year, headed into the fall football season. We've talked about that the last couple of weeks, but, up in Minnesota, we have our big state fair, and where I go and eat real foods that are very, very bad for you every year and enjoy it. Like the cheese.
Is that going on right now?
It is going on right now. Yep.
And how long does that last? Like
a week and a half.
A week and a half?
Yeah.
I know you get a lot of people there.
Every year they set new records. They have the record for most largest fair attendance in the United States. It's not the biggest state fair. It's the second largest state fair in the U.S. First is Texas, but that's only because it's 2 weeks long and has a slightly larger footprint. But we set the record daily attendance record. So I think last year they set it at 220-some thousand in one day.
Yep.
Yeah.
So what's your favorite food there?
They have something called the Minnesota Wild Rice Burger, and it is the thickest, juiciest burger I've ever had. So good. That's my favorite. And second favorite is the main cheese curd stand in the main food building. It's huge. There's always a huge line, but they move them through. And it is the best. They are the best cheese curds you will ever have. If you've never had deep fried cheese curds, these aren't the kind with the crispy coating that you get at restaurants or that they just bake in an oven. These are deep fat fried, and they home make the batter right there. And it is so good. Fantastic. But you can actually feel your arteries harden as you eat it, Cory. It is so bad for you.
Well, I mean, I thought the cheese, I would think Wisconsin has some pretty good cheese curds too.
They do, but not as good as these. These are even better. They use Wisconsin cheese curds in them to dip.
Sure. Yeah.
They're actually using Wisconsin cheese. Ellsworth, Wisconsin is the cheese capital of the world. And there's the Ellsworth Dairy where they make the cheese curds.
Yeah.
That if you go to Wisconsin or the Midwest and you eat cheese curds and they taste good, they're probably from Ellsworth. They have a cheese curd festival and they have very good cheese curds they make right there. But I'm telling you, the batter and whatever oil they fry them in at the state fair, they are so delicious. Yeah, that's what everybody kind of has to have those when they go. But every year they introduce new foods. I mean, there's crazy stuff. You can get a deep fried Twinkie or whatever. I mean, it's crazy.
Yep.
Yeah. How about you? You go to the fair at all? Eat cheese curds? Do you eat like that?
I have cheese curds if I'm in the right situation in the right place for it.
Sure.
Like if I'm in Wisconsin.
Yeah, exactly. Yeah, you kind of have to. When in
Yeah,
Rome, they say. Yeah.
exactly right.
Yeah. How have you
Um,
been?
been good.
Good.
Been good. You and I were actually in Nashville
Yeah.
kind of the same days, but really didn't see each other.
No, we didn't. I flew in. I got in too late. My flight
Yeah.
it was delayed coming in, so I was going to give you a call. I got in there Thursday night. Was there for 4 days. I ate the best food. They have some great restaurants down there. I
Sure.
wasn't downtown at all, actually. I was at studios that were close to downtown. I went to a couple of recording studios. I have friends that work in the music business there. Yeah, I went to the Ruby Sunshine in Franklin is the best breakfast. They have the best eggs Benedict. If you're an eggs Benedict person and you're in Nashville, it's worth the drive down to Franklin, to the Franklin Square, to eat at Ruby Sunshine. That place is fantastic. I mean,
there's some good restaurants down there in
yeah,
Franklin, Brentwood
they're
area.
sure. Yeah.
Yeah.
Franklin is great. Well, hey, today you've got a great show lined up for us, right?
Yeah, I do. We're going to talk about required minimum distributions.
Okay.
Maybe some. Well, first of all, what I kind of want to dive into is, what are they, right? And basically, what we're really talking about, Tony, are your retirement accounts, right? So if you have like a traditional IRA, or you have a SEP IRA, or a simple IRA, or a 401k, or a 403b, or a say a TSP type of account. Basically, it's any type of workplace retirement account that is not a Roth, right?
Okay.
So when you meet, that magical age right now of 73. So if you turn 73, 2023 or later, that's the year that you have to start taking what we call your required minimum distributions. And really, all we're saying is the IRS is now forcing you to start taking money out of your retirement accounts. Now, starting in 2033, they're going to move that RMD age to the age of 75. People are living longer, so they want you to they still want you to take it out, but they're going to delay the number of years the age that you have to start taking that out at. Now, it's important to realize that Roth IRAs do not have any required minimum distributions. So we're talking about, money that you got some type of tax benefit for putting money into it, right? Mm-hmm. It's grown tax deferred. And now it's basically saying that you have to start taking money out if you're not using it. In some cases, Tony, people are retired. Maybe they are taking money out of their IRAs, and maybe they're taking out the required amount or a little bit above the required amount. So you're not going to have any impact on you because you're already taking out, the amount or greater than the amount that's there. But, one of the things that we do for our clients is we're always going to be able to check to make sure that you are taking those required minimum distributions out at your appropriate age.
Right. So you said the accounts that you have to take RMDs from traditional IRAs, SEPs, simple, 401k, 403b, anything that's tax deferred.
Yep.
The government, the IRS eventually wants their taxes on that money. And that's why people get into situations that aren't so great, right? Because they have these traditional accounts that are tax deferred. Sure, they got a tax break and a big benefit by not having that count as taxable income in the year they earned it. But now that they're in retirement, and if they want to pull that money out, all of it's grown tax free. So you're paying taxes on everything. What you put in, the interest earned, whatever you take out is fully taxable at your full tax rate, right?
It is fully taxable. And obviously there's situations where a lot of people retire, Tony, where they need the money and they're living off of it, right? So the required minimum distribution is probably not even going to come into play. But there's a lot of people out there, Tony, that are retired, are not taking money out of these type of accounts. And all of a sudden, you have to start taking money out. And that can actually then maybe move you into different types of tax brackets in retirement.
Yeah.
You go from a 12 to 22, a 22 to 24. And now we'll talk about, some options that you can do from an investment standpoint a little bit later. But that's why it's so important to be able to work with an advisor that before you reach this age, we kind of know what your plan is going to be. Because if you don't need it, hopefully you've done some things to be able to eliminate the required minimum distributions that you have to take when you reach that age.
Right. And so RMDs can be tricky. And I know that, you really have to watch and make sure they get paid. We'll get into that. Like you said, Roth IRAs don't have required minimum distributions. And so maybe people can live off that, their Social Security. So they haven't been taking money out of these traditional IRAs or SEPs or Simples or 401ks. They've been waiting, and then that's going to be a tax burden. How are RMDs calculated? How is that required minimum distribution once you hit your 72, 73, whichever it is for you? How are those calculated?
Yeah, so basically, Tony, the IRS comes up and they publish what they call the life expectancy table. But I can kind of tell you this, at 73, for example, when you start taking your required out the first year, it's going to be about 3.78% of what your account balance is for all of them. You might have multiple IRAs as of December 31st of the previous year. So for 2025, they're looking at what that balance was on December 31st, 2024, right? And then what'll end up happening is next year, it's going to increase a little bit. So next year it's going to be, whatever, it might be 3.85, the following year, 4%, but it's going to keep increasing because as you age, your life expectancy, they're using the life expectancy table, and the older you are, the more you have to take, the higher the percentage you have to take out. Right.
Right.
So anyway, it's one of the things that we do for our clients is we calculate that. So we want to make sure that you are taking out your required amount because if you don't take it out, then now we get into what we call penalties, Tony. And really, if you don't take your RMD out, the penalty used to be up to 50% of the amount that you should have taken. Plus, you're still taxed on it.
Wow.
Right?
So the penalty is 50%.
Was
It was 50%
right.
of the amount that you should have taken out for your RMD. So there's an additional 50% plus the RMD plus the taxes.
That's correct.
On top of that.
So in 2023, they changed that to 25%. And
better.
If you do correct it, you have to go through a process, but maybe that penalty might be as much as 10%. But let's just say you have a $10,000 required minimum distribution that you forget to take, Tony. Odds are you're gonna have a penalty of $2,500.
Wow!
Just think of it that way.
Plus taxes.
Plus taxes, and that's why it's important to be able to, consolidate. Really, you want to be able to consolidate all your IRAs. You don't want to have a lot of them. Because, if you work with us, we're going to calculate what we know, right, Tony?
Yeah.
But if you have assets maybe somewhere else, that's your responsibility to make sure that you're taking out your required amount. And as we age, I think people forget a lot, and that's where you can get into the penalties.
Yeah.
So that's why I think it's very important to be able to work with someone that's, that has a good handle on what your required minimum distributions are and ways to be able to distribute that. And you have to remember this, these are all taxed as ordinary income.
Yeah.
So it's not a long-term capital gain or short-term capital gain. It's actually income, which means it can increase your income, which means it can go into a different tax bracket.
So it could bump you up into a higher tax bracket.
Yes, it could.
And that can affect other things, right?
Oh, yeah. I mean, yeah, you could go overnight from a 12% to a 22%. The one area that I see where it impacts individuals more than anything else, Tony, is usually when you lose a spouse.
Oh.
Because now you're still required to take them out. But, your 12% tax bracket, for example, just went from we'll just say $98,000 all the way down to basically around $48,000. So overnight, your 12% tax bracket just got cut in half. And a lot of times what I end up seeing is spouses all of a sudden go from a 12 to a 22% tax bracket overnight. That's why it's so important to be able to plan for the future and really try to set yourself up to get as much tax-free income as you possibly can. Because as a spouse passes away, you're going to pay a lot more in taxes if you haven't planned.
Right, but plus it can affect if your taxable income goes up in retirement, it can affect other things like Medicare and Social Security as well, right?
It can definitely affect your Medicare Part B and the premium you pay as well, depending on what your situation is. That is correct,
Yeah.
Tony.
Yeah.
Especially if you haven't been taking anything out and all of a sudden you start now where you have to take it out. Yes, that could move you. Not only do you increase your tax bracket, but your Medicare B premiums can go up too because of IRMAA.
Good old Aunt Irma.
Yeah, and
Yeah.
IRMAA.
Yeah,
That's something you really don't want to get in the mail and hear about.
No, you don't, because your Medicare premiums, people think, oh, they're 185 or around
Right.
there, but they can go as high as $600 a month if you're making too much money in retirement or pulling too much out.
Right.
So, and we talked about the penalties. The IRS makes you take these RMDs so they can get the taxes finally. I think that's important. What's next?
So let's kind of talk about what can you do now that you're taking your required minimum distributions out. And really what I'm saying is what can you do with that money, right? So the first part that I would say is there's going to be a lot of situations out there where basically you're using this money and it's going to basically cover your daily living expenses, which means you've already probably been taking money out of your retirement accounts anyway. It doesn't really have an impact on you because you've been using that income in order to live off of. And that might be the simplest option out there for you is just take your RMDs, you're going to live off of it, and you're really not going to reinvest it because you're using that for your monthly budget.
Right.
Right. So let's kind of talk about some other things you can do.
Okay.
Well, the first part is now that you've already paid tax on the money, and let's just say you don't need a lot of it or a portion of it, or maybe even all of it, right? Well, if you don't need the income, then you can reinvest those required minimum distributions into like a brokerage account or what we call a non-qualified account. Now you're going to be able to invest that in whether it's stocks or annuities or however you want to be able to invest that. These could pay dividends to you. We could put it in, you could bank it into tax, efficient funds, or, we have our taxed advantage portfolios, for example. But basically what you're going to do is you're going to keep trying to work that, have that money work for you for as long as you're living until you might need it. Maybe you want to buy a car later, or who knows what you want to be able to do with it, or maybe you want to be able to pass that on. So basically, if you don't need the money, you can reinvest it. Another thing that you can do is, and we see this quite a bit too, is sometimes you can use the amount that you're not using from your required minimum distributions. You can actually fund that into life insurance. So now you're going to have a death benefit. And really what we're talking about here is now you're trying to be able to, pass the legacy on. Maybe you're doing it maybe for your spouse, or maybe you're doing it for your kids, or maybe you're actually going to be able to do that, for your grandkids. But really what you're trying to do is be able to create a situation where you're going to be able to, pass on some type of tax-free money, to your beneficiaries. And in some cases, you might be able to, for example, to say I'm paying $10,000 a year. It might pay $500,000 in death benefit, something like that, right? So, and that doesn't matter whether it happens, tomorrow or whether it happens 20 years from now, but at least you're going to be able to have something to be able to pass on. So that's definitely something if you want to be able to try to create a legacy, have tax-free money end up going to your beneficiaries as well.
Well, yeah, and then you're right. You don't want to create a tax problem for them, so you have to take all of these strategies into consideration. And I think what you need to do is work with a financial professional, someone like yourself. You don't want to tackle RMDs on your own, do you?
No, you don't want to tackle them on your own. And, was talking about what we were talking about while you were talking, Tony. I thought even about something else, which you just basically what you mentioned is you might be taking your RMDs and say you get life insurance, right? So we know you're getting tax-free money, but
Right.
You might actually have a big IRA on the backside of that still.
Yeah.
which now like we talked about inherited IRAs just a couple weeks ago on the show.
Yeah.
Now you can use some of that tax-free money maybe to pay for some of the taxes liability that you're going to have. So now it puts you in a better situation where basically you're getting more of that money, back to you as well. Another popular option, Tony, is what we call qualified charitable distributions. So all this means is you can use your RMD to be able to pass on to a charity, and you can have up to $100,000 of this charity, or you can have up to $100,000 a year this way go directly to the charity from your IRA. So it counts towards your RMD, but you don't have to pay any taxes on it. And it's a great way to be able to give to a charity if that's what you want to be able to do.
Well, yeah, and as QCDs, we've done a whole show on that because there's so many ins and outs. But boy, you can really, that's a great, if you're giving money to a charity or tithing regularly to a church anyway, you might as well have it directly transferred from your IRA or tax deferred account right to them, because then it's much more beneficial. You don't have to pay taxes on it. Obviously, the charity doesn't have to pay taxes on it. That's a great way to minimize that tax burden.
Yeah, and from our standpoint, it's an easy form we have to fill out, right? And in order to send that RMD, to whatever charity you want to be able to give it to, or a church, or whatever you want to be able to do, right?
Yeah. I think that's really important. So giving it away is an option and then you won't have to pay the taxes on it. What's another option?
Another good one, Tony, I think is you can take some of this money, right? You're gonna receive money.
Yep.
Take that net amount, and you can actually maybe even convert some of your additional IRA to your Roth IRA and use that money in order to pay the taxes. So it's going to help reduce your future requirement distributions, right? And it's going to, now you're setting yourself up in a position to where you're going to leave more tax-free money to your beneficiaries as well.
Yeah, and that's good. That's a great thing too. I mean, obviously, if you gift it or put it into a 529 plan, that can really help out your grandkids. That's a good way to do it if you don't need it for income, right?
That's exactly right. And just like, we're going to kind of end the show here in a second, but the one thing that I would always, say, we've talked about it on the show, just because you have $1 million in IRA, you really don't have $1 million. Whether you're going to give 12, 20, 30%, to Uncle Sam or to the IRS, that's what you're going to have to be able to do. So you probably have anywhere from $700,000 to $800,000 worth of true money out of that. So you want to be able to set yourself up in a situation where you're going to have tax-free income. You're going to be able to pass more tax-free income on to your, heirs and your beneficiaries. And really the only way to be able to do that is to be able to plan for it. So, in order to, the best thing that you can do, for our listeners and viewers out there, is to set up a complimentary, financial obligation meeting with us. We can review your situation and put you in the best possible situation, when you do actually reach your requirement distribution age.
Well, yeah. So there's so much strategizing, Cory, and you've made some great points here. But the bottom line is you need to work with a trusted financial professional. I know you and the team there at Safe Harbor love to hear from folks and are happy to help them with this. They just have to schedule that consultation, because you can make very costly mistakes that can affect, and it's like dropping a rock into a lake or throwing a rock into a lake. It waves out and affects other things. It's not just this one area. You have to say, okay, if I do this and remove it here, what's that going to affect over here? What's the best strategy based on my personal situation? And you can't just say, to your neighbor or your buddy, hey, what'd you do? Or they might say, you should do this, but their situation, everybody's completely different, right?
Yeah, everyone's situation is different, Tony, and that's why it's so important to put together a financial plan, to have a strategy around taxes, around your requirement distributions, around Social Security, right? There's so many things that you need to have a plan around. And really the only way to be able to do that is to find the right situation, the right advisor for you to be able to make sure that they're handling all these different types of areas as you kind of go through retirement.
Yeah. Yeah. And I just think that this is really important. Why don't you let our listeners know how they can get a hold of you before we go?
Yeah. For our listeners out there, you can always give us a call at 614-760-0670 or visit us online at safeharboroh.com. And again, all meetings are complimentary. There's no financial obligation. We're here to truly help you have the best retirement that you possibly can.
All right. Sounds great. Thanks, Cory. And that does it for today's episode of Financially Fit Radio with our host, Cory Sickles.
Thank you for joining us for Financially Fit Radio. Don't head into retirement without a strategy that addresses both income and taxes. For more information, please contact Cory Sickles at Safe Harbor Wealth Advisors at 614-760-0670 or visit safeharboroh.com now. Join us again soon for another episode of Financially Fit Radio.
Investment advisory services are offered by Safe Harbor Wealth Advisors, LLC, and SEC Investment Advisor. Insurance products and services are offered through Safe Harbor Retirement Group, LLC, an affiliated company. Safe Harbor Wealth Advisors, LLC, and Safe Harbor Retirement Group, LLC, are not affiliated with or endorsed by the Social Security Administration, the Federal Medicare Program, or any government agency. All matters discussed during the show are for informational purposes only. Each individual situation may vary, and the opinions expressed here may not apply to everyone. Materials presented are believed to be from reliable sources, and no representations can be made as to its accuracy. All ideas and information should be discussed in detail with one of our qualified representatives prior to implementation. Calling this number will direct you to a licensed sales agent.